Hello and welcome back to this week's market update coming to you from Kelly. Today is April 21st, Friday morning, 2023. We are super excited to bring you another week of economic updates. Diving right into how the markets did this week, equities ended the week of Thursday, April 20th, on a downward trend as all three major indices closed in negative territory. We saw the S&P close down about 0.5%, the NASDAQ down about 0.6%, and the Dow Jones down about 0.8%. So really, investors are becoming more concerned about a slowing real estate market, given the economic data that we got this week in that industry, as well as initial claims starting to tick up a little bit. So we'll get into our economic updates next here. Also, in terms of a market update, I figured it would be helpful to look at interest rates and where we are in terms of the interest rate cycle, given the economic data revolving around housing, claims, and other leading indicators this week. So here you can see that the 10-year U.S. Treasury yield, as well as the Fed funds rate and the average 30-year fixed rate mortgage rate. And so that rate for the mortgage is going to be the top, the Fed funds, obviously the stair steps, and the 10-year U.S. Treasury yield as well. So just in terms of that, you can see that we're in much higher levels than we were pre-COVID. You can see the main drop off in interest rates as the Fed quickly cut rates, and how it's been really picking up ever since about January of 2022, even before the Fed officially hiked rates. So you can see we're down a little bit from our peaks of the US Treasury yields as well as the mortgage rates, but still much higher than they were just 1 year ago, 2 years ago, 3 years ago. Really big moves in interest rates. So a big week for real estate data. We got housing starts this week on Tuesday morning. And so the housing permit start and completion data for the month of March came in. It pretty much demonstrated what we already knew, that higher interest rates and a slowing economy have definitely made their mark in the home construction industry. And so we saw from March of 2022, permits were down 24.8%, really big fall right there. You can see where we were 1 year ago here compared to where we are now. We had housing starts down about 17% from a year ago, and housing completions were up 12%, obviously, because that's more of a lagging indicator in that industry. So you can see that these data points, it might look strong, 1.4, 1.5 million, but compared to a year ago, much weaker housing data in that form. On top of the housing starts and permits data, we also got existing home sales for the month of March, which showed some pretty stark differences that also echo the same ideas as the housing starts. So you can see we had a 22% decrease in home sales from 1 year ago, and even from 1 month ago, from February, we had a 2.4% home sale decrease, which is odd because normally you think springtime, more people are moving and selling their houses and buying houses, but this was not the case in March this year. So that amounted to just a little bit less than what was expected at 4.4 million homes sold, and inventory also increased to about 2.6 months of inventory compared to a year ago. So houses are sitting on the market longer, and also pretty notable, home prices actually went down in terms of the median sales price, went down about 0.9% from a year ago. So definitely seeing that lagging impact of the higher interest rate environment in this data for sure. Also, we got the initial claims data, as we always do, for the week ending April 15th, ticked up to 245,000, so kind of a higher data point for last week. That was up about 5,000 from last week's upwardly revised 240,000. So like last week's data, we're not seeing the recessionary unemployment that we might see in the next few months or year or so, but things are definitely trending upward ever since that low in mid-January. So we're definitely moving up in initial claims, and that'll be interesting to see how it moves with the unemployment rate as we get that in a few weeks here. Another really important data point of this week, we got the Conference Board's Leading Economic Indicator Index, which demonstrated a decline of about 1.2% month over month in March. So this marks the 12 consecutive months of negative growth since about April of 2022. So you can see here has really moved downward over the last year or two. which is definitely a concerning trend for the US economic outlook, as this index is pretty accurate in predicting recessions. You can see how it dipped quite a bit in the 2008 financial crisis as well as the tech bubble. So we're not quite at those levels as, COVID or the crisis, financial crisis, or the tech bubble yet. We're not quite down there, but we are moving downwards pretty quickly. So definitely interesting to see on these leading indicators how accurate it'll be and when we'll see a recession in the next 12 months. One last update here, we got the earnings for a few more big banks as well as Netflix and Tesla as we are in the second week of our earnings season here. Got a lot of mixed results, especially seeing the banks affected by that Silicon Valley Bank uncertainty. And we saw Morgan Stanley, Bank of America, Goldman Sachs all report earnings. All of them beat their earnings estimates, but demonstrated some serious weakness in their investment banking businesses. So you can see here in the chart just where these big bulge bracket banks were in 2021 and how all of them have declined really since then, except for Bank of America, really. But all of them have declined in Q2 of 2022. So we're feeling that weakness even last year. And then now you can see in all of these big banks, their investment banking has really consolidated as less deals are being made. There's no IPOs, and they're taking a big hit, most of which have taken about a 20 to 26% hit to their investment banking revenue in the first quarter here. In other news, we got Netflix. They met their earnings expectations, missed the subscriber count estimates as the streaming giant really was continuing to focus on cracking down on that password sharing issue that they're experiencing. On top of that, we got Tesla. They just barely met their earnings estimates and their profit margins actually slimmed down a bit, which was not encouraging for investors as the company announced another shift towards a lower cost strategy. So definitely a lot of moves in all of these stocks as we continue to watch out for quarter one earnings season. In all circumstances, looking at all of these economic updates and data as they come in, we're really not looking at a brighter picture in the future in the next 6 to 12 months, really looking at the possibility of a recession. It's just more so a question of how soon and when. So as we continue to monitor these data points, we will best manage each of our portfolios per their mandates and per their natures. We look forward to continuing to stay agile on these economic updates and provide you with another update next week. Thank you.